Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Well, today our show is called Self-Storage Industry 2014. First, we'll talk with Ryan Severino with REIS to see how the self-storage industry is performing, including property-level performance, the investment market, and market projections for 2014. Then we'll get a closer look at the sector, including investment options and tips for operators from the Self-Storage Association. Then we'll talk with an attorney who specializes in the self-storage sector about mistakes operators and investors should avoid. Well, please welcome my first guest, Ryan Severino, Senior Economist and Associate Director of Research at REIS. REIS provides commercial real estate trends and forecasts of rent, vacancy, and inventory in up to 275 metropolitan areas and more than 6,300 market segments. Ryan, thanks for joining us today.
Hey, Michael, good to talk to you again.
Well, we appreciate it. And Ryan, to get us started, when did you guys at REIS start tracking the self-storage industry, and why did you? I mean, is the sector gaining some stature in the investment market today?
You know, we started publishing data and forecasts a few quarters ago in 2013. We got to a point where we genuinely felt like self-storage, which I think has been regarded as one of the key secondary property types, at least going back the last 10 years or so, was becoming more prominent. We were increasingly getting questions about coverage from our client base, questions from the media, and so we decided that we were going to go ahead and initiate coverage on the sector. Now, it definitely took some time to do the homework, do the research, build the modeling, get it up and running, but I think we're very happy with the product that we're putting out today.
Okay, well, that's great. I'm glad to see that you're covering it. Well, what do you see for returns and cap rates in the self-storage space?
I'd say generally cap rates for self-storage, they've been trending downward clearly since the recovery. I'd say we're now in kind of the 6.5 to 7 range, certainly over the last couple of years. I'd say currently we're closer to the bottom of that, about 6.5%. I'd say Class A properties are probably trading somewhere in the neighborhood of about 6. The Class Bs are somewhere up probably around 7, and then the Class Cs are probably a bit higher than that, probably in the 7.5 to 8% range. So, a pretty good showing on the part of self-storage over the last few years. Right,
and if you're just driving down the road and you're rolling the dial on the radio, you also can get cap rates on some smaller properties that are going to be a lot higher than that. But based on these A and B, these institutional quality properties, how do these cap rates relate to other sectors, Ryan?
I'd say they compare pretty favorably right now to the other major property sectors. I'd say as of the third quarter, the mean cap rate for apartments is about 6.4%. The mean cap rate for office is about 6.7%. The mean cap rate for retail is about 8.1%. So on a comparable basis, self-storage shows up pretty favorably. However, I think the one thing that is still important to note is that there's still a selection bias occurring in the transaction markets today. Investors are still being choosy about what they buy and sell, and transaction volume for all property types is still down relative to where it was before the recession. And by that, I'm talking about more normal levels, not just the bubblicious volumes that we saw right before the bottom dropped out of the market. So I think even with that selection bias, it does actually hold up pretty well relative to the other major property types.
Okay, and let's talk about performance a little bit, vacancy and rental rates. What did you see through the downturn, and what do you see for trends now on performance at the property level?
Fundamentals in the sector have really been improving during 2013, which is part of a continuation from the last couple of years when the sector really started to recover. So through the end of, say, the third quarter, vacancy is down about 230 basis points from the beginning of the year, down from about 14.9% all the way down to about 12.6%. Meanwhile, asking rents have been growing this year by about 2.1% year to date. So all in all, that's a pretty good performance on the part of the sector, and clearly it's still in recovery mode. I mean, we are a far cry from where we were in late 2011, when vacancy was at almost 18%. And so it's been a strong performance over the last 2 years. I think it's definitely rebounded along with the economy, even though the economy has not been a stellar performer over the last couple of years itself.
I see. Well, we're talking with Ryan Severino with REIS about the self-storage market. And Ryan, what do you expect for 2014 moving forward for performance? Is this trend going to continue to improve?
Yeah, I'd say we expect the sector to continue to recover through next year, although I do expect, it's sort of like we're seeing with some other sectors, the pace of recovery to slow down a bit. I think vacancy rates will probably be down another 80 or so basis points from the end of this year in 2014. I think asking rents are probably expected to grow by about 2.8%, which should be on par with about where 2013 ends up. And so I think it's continued improvement in the sector, but it's just difficult to maintain that pace of vacancy compression. So I'd say ongoing improvement, maybe over the medium term we could see some acceleration in rent growth, but it's just going to be difficult to maintain that kind of vacancy compression over the next few years.
Okay, and let's talk about property values. Now that we're covering it on the Commercial Real Estate Show, and you guys at REIS are covering it, are we going to see values increase and cap rates compress some?
I think so. I think we generally expect to see cap rates slightly down, say, over the next 1 to 3 years. Again, sort of like with vacancy, I don't think you will see the kind of cap rate compression that we've seen over the last few years, and certainly not if interest rates start to rise in 2014 as many expect. But that said, I really think that we could see some downward trending in cap rates as hopefully the economy accelerates, as demand for the sector starts to ramp up a little bit. I think that will somewhat offset the upward pressure on cap rates that we're likely to see from rising interest rates.
Well, that's interesting that you bring up interest rates and cap rates of all sectors because, it seems like that, if tapering is going to happen, right, at some point next year. So as tapering starts and the stock market starts to react to that, do you think that we might see more money moving from the stock market into hard assets like commercial real estate next year?
It's certainly a possibility. I think one of the great things about commercial real estate is that it is a hedge against inflation. And if the economy starts to accelerate, certainly with the expansionary monetary policy that we've implemented over the last few years, there's somewhat of a chance that we do start to see greater inflationary pressure than we've seen over, say, the last 12 to 24 months. And I think that will start to come back into focus as investors think about where they could possibly place assets. If we do start to see the stock market pull back, the thesis about commercial real estate being a good hedge against inflation and an attractive alternative to equities. Certainly nobody is going to be, or not many people are going to be interested in fixed income while interest rates are probably trending upward. So you could actually see commercial real estate be a safe haven for many investors over the next few years.
Well, I think that's interesting. I mean, I agree with that because I think there's going to be some people in the stock market that are going to get a little nervous when the Fed quits buying, artificially maybe, some people say, pumping up the market. And then we've had very little new supply, right, in all the sectors. And what do you see for new supply for self-storage market?
Honestly, right now, we do see supply increasing relative to where it's been for the last few years, but I don't really see it being an impediment to the market's recovery. In the markets that we track, the 50 or so markets that we track, next year we only expect to see maybe somewhere between 25,000 and 30,000 new units come online. So relative to the size of the overall market, it's really not that much. And as I mentioned before, we do expect to see vacancy rates continue to trend down, which means we expect to see net absorption outpacing new construction activity. And so I would say to people out there, be a little bit cautious about construction activity. Certainly do your homework if you're considering an existing deal or a development deal. But I don't think it's not the death knell for the recovery in the self-storage sector at this juncture.
All right, well, that's good news. Well, we appreciate you being with us. And before you go today, can you leave us with a tip for our listeners?
I really think that this is an overlooked property type. I think while some institutions have gotten involved and certainly consolidation is still ongoing in the industry, it's still a very fractured market, certainly vis-a-vis the other major property sectors. I think there's still a lot of good deals out there. I think people really need to do their homework, and I think our data can actually be very helpful in the process. And I think people have been skeptical about self-storage data in the past. They didn't think that it was so trustworthy. I definitely recommend taking a look. I'm an economist and not a sales guy, so making pitches is not my strong suit, but I can tell you, as someone who's followed self-storage pretty closely for about the last 8 years, and in previous roles I've provided a lot of research support for major acquisitions done by large institutional investors, I honestly would have loved to have had the kind of information that we're producing today. So I would say to people out there, I think the market still has a lot of good opportunities, and I think the ability to do your homework and find good deals is better now than it's ever been because of better data and better transparency in the marketplace.
Well said, Ryan. Thanks for joining us today. We appreciate it.
Thanks again, Michael. Always happy to be on.
If you'd like more information from Ryan Severino and REIS, visit REIS.com. We'll stay with us in just a moment. We'll have insight from the Self-Storage Association. I'm Michael Bull. You're listening to the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.